Good day, class. I'm Analytics Doc, and today we're diving into the foundational language of finance, the terms that shape how economies move, how businesses function, and how personal wealth is built or lost. Whether you're investing, budgeting, or simply watching the news, these concepts form the lens through which we interpret financial activity. For the purposes of protecting my personal identity and privacy, my voice in this video has been digitally altered and my visual likeness has been intentionally obscured. These measures are taken to prevent misuse, harassment, or unauthorized distribution of sensitive personal information. Any resemblance to real individuals is purely coincidental, and all opinions expressed remain my own. Unauthorized use, replication, or identification attempts of my likeness or voice from this content are strictly prohibited. Let's start with assets. Assets are resources with economic value that an individual, corporation, or country owns or controls with the expectation that they'll provide future benefit. That might sound formal, but think of assets as anything of value. Your car, your laptop, a stock portfolio, or even intellectual property. If it can be sold, rented, or appreciated, it's likely an asset. Now, in contrast to assets, we have liabilities. Liabilities are what you owe, debts or obligations that require future payments. This includes things like student loans, mortgages, and credit card balances. In a personal budget, subtracting liabilities from assets gives you your net worth. In business, that difference is known as owner's equity. Speaking of equity, equity represents ownership. In simple terms, it's what you truly own after debts are paid. If you have a house worth $300,000 and owe $200,000 on it, your equity is $100,000. In the stock market, shareholder equity reflects the ownership interest in a company. Let's clear up two terms that often get confused: revenue and profit. Revenue is your total income from sales or services before expenses. Profit, on the other hand, is what remains after expenses are subtracted from revenue. So, a company might earn $1 million in revenue, but spend $900,000 on salaries, rent, and production. The result? A profit of $100,000. Now, let's look at interest, one of the most double-edged terms in finance. Interest is the cost of borrowing money or the reward for lending it. If you borrow $1,000 with a 10% interest rate, you'll owe $1,100. But if you invest $1,000 in a bond at 10%, you earn that extra $100. Interest powers credit cards, mortgages, and investment income alike. Inflation is the rate at which prices rise over time, reducing purchasing power. When inflation is at 3%, something that costs $100 today may cost $103 next year. It's normal in growing economy, but too much inflation can erode savings, while deflation, falling prices, can cause stagnation. Liquidity refers to how quickly and easily an asset can be converted into cash. Cash itself is the most liquid asset. A house, while valuable, is far less liquid because it can take months to sell. Liquidity matters in emergencies or in markets that move fast. One of the golden rules of investing, diversification, means spreading your money across different assets to reduce risk. If one stock falls, another might rise. A well-diversified portfolio protects you from the volatility of individual investments. That wraps up our introduction to some of the most essential terms in financial literacy. These concepts are just theory. They are the building blocks of informed decision making, whether you're managing your personal budget or evaluating a company's balance sheet. Remember, understanding finance is not about being wealthy, it's about being wise. I'm Analytics Doc. Until next time, stay curious, stay analytical, and always follow the numbers.